Bloomberg Audio Studios. Podcasts, radio, news. You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Let's stay on the zone of retail sales and what it means then for retail stocks. Joining us now is Shor, Senior Equity Analyst at Columbia Threadneedle Investments, joining us from Boston. All right, Mari, just talk about the broader landscape. What was your takeaway for retail sales?
Hi, thanks again for having me. Yes, when looking at the adjusted numbers for February up slightly versus January, I think the results overall were solid. We saw the strength led by non-store retail, while most of the other categories slowed versus January. But again, this was very much expected. And I think the key question here is this slowdown transitory or more structural? And while I do acknowledge the political turmoil and rising inflation expectations, I think when you listen to a lot of the companies as they reported earnings over the past few weeks, listening to the large credit card companies and large banks, it does seem that most of the pressure that we saw in February was weather driven, and that there has been some improvement in March to date. So I actually believe a lot of the pressure that we're seeing is more transitory, but I acknowledge that the backdrop is still, very tumultuous and makes it difficult for investors to really stick their necks out here.
So, Mari, what are the companies? We saw Kohl's just last week give a disappointing forecast. How representative is that of companies actually seeing some weakness, or maybe just we need to be cautious here in our outlook?
I think it's a little bit of both. I mean, when I look at the results today, I think we are back to a lot of the same category and channel trends that we saw in 2024. So that would include relative outperformance in categories like food, personal care, clothing, and general merchandise, and then weakness in other areas like home, electronics, sporting goods, and department stores. So to your question about Kohl's, I mean, the department stores continue to lose share. And at the end of the day, retail is a low single-digit growth category, and it's all about who's winning and who's losing share. And so our playbook is to really stick with the companies that are gaining share. And I think there's a couple ways to do that, but I would not take Kohl's results and extrapolate those across a much broader group.
So what do you guys like?
So I think, looking at different ways to play that share gain opportunity, I think there's really two buckets. Number one is the companies that offer value, convenience, and a broad assortment. And within that bucket, I would put the mass merchants like Walmart, warehouse clubs, and the off-pricers. And I think that bucket remains very well positioned, especially in a weaker macro backdrop. Then on the other hand, you have best-in-class global brands, which are executing very well from a product and marketing standpoint and gaining share. So within that bucket, I would put companies like Gap, Ralph Lauren, Tapestry, and even Contour brands.
Mari, what are your companies saying about tariffs and their ability to, how they're thinking about passing that along or taking that in their margin? What are you hearing from the companies?
It's a great question. This is very top of mind, of course, for investors. And most companies at this point have included the impact of the tariffs that have already been announced in their guidance. However, there is the risk that, the tariff headlines continue to worsen, and that is not included in the company's guidance. So I think that does create some risk as we look forward. I think, the companies are looking at various ways to mitigate the impact. Some of it is moving production around. Some of it is pushing back on their sourcing sourcing partners. And we saw Walmart in the headlines last week along those lines. And then some of it will, the higher prices getting passed through to the consumer. And, I would say to that, I think that the price increases for the most part would be modest, but there are some categories like consumer electronics, which would need to take significant pricing to offset worst case China tariffs. And I think that will be very difficult to engineer in this macro backdrop.
Yeah, absolutely. Mari, thanks a lot. We really appreciate it. Thank you so much, Mari Shor, Senior Equity Analyst, Columbia Threadneedle Investments, joining us from Boston.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Equities in the green, just a touch, because volume also is quite light. Phil Orlando, Chief Equity Market Strategist and Head of Client Portfolio Management at Federates Hermes, joins us now. Hey, Phil, every note that I get on my desk is it's a tricky trading environment. No one's coming out and saying buy the dip yet. It's all TBD. It's all question marks surrounding eventual growth, margins, and earnings. How do you look at it?
So we don't materially disagree with that, but we did think that the market was ahead of itself in terms of the dramatic outperformance of the Mag 7 versus the forgotten 493. And so, our call has been that we were hoping for a move down in the S&P 500 that would take the market back to about the 200-day moving average. Now, for the S&P, that's about 5,700, or was about 5,700. The stocks got down to about the 5,500 level on Thursday, and then we had, Friday's nice bounce, and then we're doing a little better this morning. So the question is, all right, so we've achieved the move down below the 200-day moving average. You're in correction territory. Is this the point we ought to be stepping in? It's been a relatively sharp decline, about 11%, in a relatively short amount of time, about 4 weeks. Generally, these things need a little bit more seasoning before the bottom sort of establishes itself. So I guess that's a long way of saying we're getting interesting here. If you're a long-term investor, I couldn't disagree with you starting to nibble here, but in terms of getting an all-out, full-blown market capitulation signal, I don't know that we're quite there just yet.
So, Phil, to the extent that this market's pullback has been generated in large part by uncertainty about some economic policies coming out of the Trump administration, whether it relates to tariffs or whatever, that doesn't seem to be changing anytime soon. Does that continue to be a headwind, do you think, for this market?
Well, that's a really good question, Paul, because if you ask the average strategist or whatever, that continues to be a significant headwind. You ask that question to Federates Hermes, we've got somewhat different view. Based upon, listening to what the president was talking about during the campaign last year, looking at the economic data right now, we've got a $1.2 trillion balance of trade goods deficit at the end of last year. GDP in the fourth quarter on a chain dollar basis was $23.5 trillion, which means that we've got about a 0.5% deficit in terms of GDP growth last year for no reason other than what was going on with trade. So you look at the quote unquote trade war that Trump is waging here. In some ways, it's reciprocal that these countries are waging tariffs against us, and to some degree, the president is trying to neutralize or level the playing field, and if he's able to successfully do that, that represents the potential for 0.5% more GDP growth. Now, one of the president's goals and one of Treasury Secretary Scott Bessent's goals is that we want to generate trendline GDP growth of 3% or higher on a sustainable basis. Well, if you could figure out a way to neutralize this $1.2 trillion trade deficit, that's a significant step in that direction. And so we're looking at what's going on right now as sort of a necessary step to try to achieve that economic goal. Neutralize the trade deficit, boost GDP growth.
It's just a matter of phase one versus phase two and how long the difference between the two lasts, right? Because phase two, in theory, should also be growth incentives like deregulation and tax cuts. Does the longer that gap persists, does that worry you or no?
Well, again, we're taking a longer-term view here, and that when a new president comes into office, typically you'll want to implement the more difficult policies early. Swallow the bitter medicine in year one. That way, the positivity associated with those fiscal policy initiatives will begin to bear fruit in year two and beyond. So as we're modeling all of this out, we're saying, okay, yeah, we're gonna have a hit to GDP growth in the back half of 24 and the first half of 25. But as some of this stuff actually occurs and we get the tax cuts later in the year, and then as this grows into economic growth in calendar 26 and calendar 27, we're then saying, okay, based upon our analysis, that suggests we've got a 7,500 S&P 500 2 years from now. Discount that back a year, that's a 7,000 forecast. Discount that back a year, we thought we'd end last year at about 6,200. We got up to about 6,150. So I think we figured out the trajectory in terms of fair valuation, but you've got this air pocket that's occurred because of the volatility and uncertainty associated with how is this policy going to be implemented? What are the near-term impacts? So we're taking the longer-term view, saying, okay, we've just had an 11% correction. That's pretty attractive. If we're a long-term holder or a long-term buyer and are looking out 2 years, this is very attractive. If I'm looking out, how is the market going to return over the next week or the next month? It's highly uncertain, and you've got two completely different scenarios to consider whether or not you're investing long-term versus short-term.
Hey, Phil, thanks, as always, for joining us. Really appreciate it. Phil Orlando, Chief Equity Market Strategist, Head of Client Portfolio Management at Federates Hermes, joining us there with his market call.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Looking at the IN Go function on the Bloomberg terminal gives you the indexes and the performance for the fixed income space. The Bloomberg U.S. Ag Fixed Income Index is up about 2.08% this year. The best performance has been in the mortgage-backed securities business, so a little bit more on the risky profile there. So let's talk about the fixed income markets and how they're dealing with a lot of this uncertainty, policy uncertainty coming out of Washington, D.C. Steve Purdy joins us, co-head of global credit at TCW based in Los Angeles. Steve, uncertainty's kind of been the word so far here in 2025. How have the fixed income markets been dealing with it?
Hey, first of all, thanks so much for having me. Really appreciate being back. It's funny. Donald Trump told us when he campaigned that tariffs were his favorite word in the dictionary. And now that we've gotten tariffs, the market is reacting pretty dramatically. And I think there's an assumption that a lot of this was a bluff and that there wouldn't be dramatic policy shifts. But as all these headlines keep hitting us, that is where our market is focused right now. It's occupying the minds of not only investors, but management teams as well to try to navigate from one headline to the next and define what the next path looks like for their CapEx spend and really earnings outlook.
As an investor, what's the path of least resistance right now? As the equity market kind of struggles for direction, how does that wind up impacting the credit market? Do we get more inflows, outflows? How does that work?
Yeah, no, that's an excellent question. I mean, clearly, we've had an unbelievable run in equities for the last few years. It's been the only game in town, and particularly the Mag 7. People have kind of ignored our asset classes. I think this last change in sentiment has really widened people's perspectives as to where else they can put their capital, including the credit markets are going to be a big beneficiary of that as people look to income to stabilize their overall portfolios, and we agree. At the same time, some of the real challenges that are being addressed in the equity market are also plaguing the credit markets. And what that really comes down to is, what do future earnings look like? And we have this strange, there's this strange relationship between the stock market and the real economy. Typically, the real economy drives the stock market, but we feel like over the last year or so, it's almost become the reverse. And a lot of the spending we've been seeing, particularly from the wealthy cohort, is driven by the wealth effect, meaning home prices are up and more importantly, equity prices are up. So our concern is as investors look at their equity performance, it starts to actually impact what they're doing on a spending basis. And that's what we're hearing from companies right now is people are getting a little spooked by policy, a little spooked by the price action in the equity market, and that is causing them to change their behaviors, which we think will actually flow through to earnings as we look forward to the next few quarters.
Steve, for the longest time when Alix and I would speak to fixed income pros like you, we would hear discussion about how tight credit spreads are. In this time of, I guess, growing uncertainty, are those spreads widening at all?
Yeah, the narrative over the last year has been what could possibly move spreads wider. And we've been kind of underweight credit spreads on the narrative that credit spreads, unlike equity, are a mean reverting asset class. They don't go up and to the right. They tend to rotate and gyrate around a baseline. And at these tight levels, the narrative was there's just nothing that could break out from the economic growth, particularly in the United States of America. And that has been changed. Spreads rallied from kind of October when it looked like Trump was going to be elected all the way through Inauguration Day. All of that was on the optimism of animal spirits and how that would continue to keep the economy chugging and credit spreads compressed. Once we saw this administration in action, however, we've seen a move wider. And so, credit spreads have gone on the investment grade side from kind of the high 70s, which are the all-time lows for the last decade plus, and widened out about 15, 20 basis points. And so to us, that feels healthy. It also feels like the direction of travel will continue in our minds over the course of this year.
But if the underlying issue is that we don't know what the economic growth outlook will be for the United States economy, look at the OECD downgrading growth and upgrading inflation, I mean, doesn't that wind up hitting credits in some capacity?
It really does. I mean, we're not very, very sophisticated in bond land. We just like cash flows. That is the most important thing.
I see. So it's like a safety play even with the risks.
Correct. We still think that this is a good place for investors to be compared to where the lofty valuations are in the equity land, even still after a 10% pullback. We think this is a much better place for investors to kind of really rely on some of the stronger parts of the economy while not leading into frothy valuations.
Steve, thanks so much for joining us. Really appreciate it. Steve Purdy, he's co-head of global credit at TCW out there in LA. TCW, Trust Company of the West, huge asset manager, both in fixed income and equities.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.